Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be discussing how weight loss treatments could disrupt other industries. Last week's Market Insights covered the remarkable growth of GLP-1 diabetes and weight loss treatments. For now, the market is dominated by Novo Nordisk, but at least a dozen other companies are developing and testing similar drugs. This week, we are taking a look at some of those companies. We're also highlighting some of the industries and companies that could win or lose if the use of GLP-1 continues to increase. Before we dive in though, here's our quote of the week, which is from a Chinese proverb. The best time to plant a tree was 20 years ago. The second best time is now. Now, let's dive in. What happened in markets this week? Here's a quick summary of what's been going on. Firstly, from Reuters. Gold price holds on to gains as the price of a gold bar reaches $1 million. What's our take on this news? Economic uncertainty, geopolitical risks, and anticipation of rate cuts make this the ideal environment for gold. Gold is seen as a safe haven asset, and when economic policy uncertainty increases, there's usually an appreciation in gold prices as investors look to investing in something that is relatively more stable. With the gold price up 21% this year and trading at around $2,500 per ounce, a 4,000 ounce bar will now cost you $1 million. Gold has usually proved to be a great hedge against market downturns and volatility. However, the three factors driving demand could or will eventually change, in which case it will no longer be the ideal environment. We would still regard it as a hedge rather than something to go all in on. Next up from Yahoo Finance. PDD sinks as competition amongst discount e-tailers intensifies. What's our take on this news? It's an age-old tale in any emerging industry. Profits attract competitors and competition brings down margins. PDD Holdings, which owns the Temu e-commerce platform, reported results that were for the most part better than expected. However, their guidance and comments about the future spooked investors. The management team mentioned intensifying competition, slowing revenue growth, and likely pressure on margins, which are already slim. The company also plans to invest more aggressively in growth and focus on premium brands. So, lower margins may actually come as a result of higher spending rather than lower gross margins. This could be a sign that the company doesn't have confidence in the current model, which is focused on low-priced, white-label products. Next up from CNBC. Super Microcomputer shares fall 19% after delaying results filing, short seller report. What's our take? The higher they fly, the further they fall. On Tuesday, Hindenburg Research published a report alleging accounting manipulation and disclosed a short position. The next day, the company said it would have to delay the filing of its annual report. Short sellers like Hindenburg have been known to exaggerate and even to be completely wrong, but the delayed filing seemed to add credibility to their claims. It's quite possible that the company wanted to address the claims and will be able to convince investors that there isn't a problem. Only time will tell. 19% is a big move, but it shouldn't be surprising for a stock that gained 1,000% in a year. Position sizing and diversification are the best way to mitigate risks like this. Next up, from the Financial Times. Buffett's Berkshire Hathaway joins the $1 trillion market cap club. What's our take on this? Warren Buffett's company hit the milestone on Wednesday and broke a record in doing so by becoming the first non-tech company to trade at a market cap of over $1 trillion. There's a reason why we endorse his investing ethos. His methodical approach to investing has transformed the once textile company into the largest multinational conglomerate in the world. The Oracle of Omaha has spent much of the year increasing the company's cash reserves, including a noticeable $50 billion trim of its holding at Apple. While the sell-off was significant, Apple still remains the company's largest holding. Berkshire Hathaway's cash holding sits at a staggering $277 billion. As Buffett mentioned, he struggled to find a more appealing prospect on the market. Next up from Reuters. Nvidia fails to impress the market despite a stellar earnings report. What's our take on this news? Despite delivering some excellent headline figures like a 122% increase in revenues year on year, investors were left wanting more as Nvidia traded down 6% after hours. Nvidia beat earnings expectations and subsequent guidance for the following quarter was also raised, but it seemed earnings didn't exceed estimates by enough in the eyes of the market, who have been used to Nvidia absolutely crushing analyst estimates. Nvidia's guidance of 80% year-on-year growth for the next quarter seems to be what disappointed investors the most, as it signals a potential cooling off of the AI hype train. Can you imagine being disappointed with 80% revenue growth? It seems a little ridiculous to expect triple-digit growth to continue in perpetuity. Nvidia also announced a $50 billion share buyback plan, a step up from the $25 billion share buyback plan they announced in August 2023. At current prices, this would be representative of around 2% of the current shares on issue. And last up, from Barron's, Powell hopes the Fed hasn't waited too long to cut rates. What's our take on this? This week, the Federal Reserve met at Jackson Hole for the Monetary Policy Symposium to discuss the next phase of monetary policy. The Fed's messaging was clear. With inflation edging towards the 2% target and with the labor market cooling, the market should expect a rate cut in September. Powell seems confident in being able to deliver a soft landing with the first rate cut since March of 2020. Anticipation of a rate cut has seen the US dollar drop to its yearly low against other G1 currencies. The futures market now expects the Fed to cut its federal funds rate by 100 basis points or more before the end of the year, a move which could spur on more weakness in the US dollar. There's been a lot of talk about whether this rate cut is coming too late, but time will tell. A bigger concern would be to come in too aggressively with rate cuts and have inflation start heating up again. Now, with all that covered, let's dive into the main piece. The GLP-1 pipeline. Most of the large pharmaceutical companies have been developing GLP-1 variants for a number of years. Following the successes of Novo Nordisk's Ozempic and Wegovy, these companies have accelerated the development and testing of these treatments. New treatments are being developed for other diseases and conditions and to reduce the side effects. Both Eli Lilly and Novo Nordisk are both developing variants, including one that can be taken orally or injected less often. Other notable companies include the likes of Amgen, who's developing Maritide, a GLP-1 drug that only needs to be injected monthly, unlike current treatments that require weekly injections. The treatment has shown very promising results during Phase 2 clinical trials. Final results from the Phase 2 trial are only expected later in the year, but the company is already preparing for a broad Phase 3 trial. Another notable company is Roche Holding. It's working on several GLP-1 treatments which it acquired via an acquisition of Carmot Therapeutics for its CT996 drug, which is taken orally. The treatment has only completed a Phase 1 trial, but resulted in 6% weight loss after 4 weeks. AstraZeneca has acquired the license to produce a GLP-1 from Icogene. The company is testing a treatment regime combining this with its own therapies to treat obesity and its comorbidities. Zealand Pharma is far smaller than the companies mentioned above. Zealand is developing a long-acting amylin analog, which is slightly different from a GLP-1. Recent tests showed promising weight loss and a better patient experience. Lastly, Viking Therapeutics is developing several treatments, one of which is expected to begin Phase 3 trials soon. Its most promising candidate is being developed to be injected weekly or taken orally. Some of the other companies developing their own GLP-1s include Pfizer, Merck, Scholar Rock, Hanmi Farm, Chugai Pharmaceutical, and Innovent Biologics. In the article, we have a link to a more comprehensive breakdown of GLP-1s in various stages of testing. When trial results are released, a lot of attention is paid to weight loss percentages relative to the drugs that are currently approved. However, when it comes to weight management, the side effects and how easy they are to use could ultimately be just as important. So now let's talk about GLP-1 ETFs. It didn't take long for ETF issuers to respond to investor interest in GLP-1 drugs. In May, 2 new funds that focus specifically on the companies manufacturing and developing GLP-1 treatments were launched. Firstly, the Round Hill GLP-1 and Weight Loss ETF, with the ticker OZEM, has 40% invested in Novo Nordisk and Eli Lilly, with the rest invested in companies developing new treatments. Secondly, the Amplify Weight Loss Drug and Treatment ETF, with the ticker THNR, is less concentrated in the 2 large manufacturers and also includes other companies in the supply chain. Another ETF, the TEMA GLP-1 Obesity and Cardiometabolic ETF, with the ticker HRTS, was launched in December of 2023. This fund takes a broader view of the potential treatments of diabetes, obesity, and cardiovascular disease. The fund is also actively managed, which could give it more flexibility. These ETFs offer diversified exposure to the industry, but there are a few things to keep in mind. Firstly, all three have quite a lot of exposure to companies with drugs that are years away from coming to market. At the same time, many of those companies have large portfolios of completely different drugs on the market. Secondly, these funds are still quite small, so liquidity could be an issue. And lastly, the expense ratios are quite high, though about average for thematic funds. So now that we've talked about how to get exposure via different stocks and ETFs, let's talk about the other side of the coin, and that is which industries are likely to be disrupted. The successes of Ozempic and other GLP-1 treatments potentially means trouble for other companies, particularly those in the medtech and food and beverage industries. In the second half of 2023, valuations for these companies came under pressure. The chart below shows the PE ratio for Dexcom, which manufactures continuous glucose monitoring systems, known as CGMs. The valuations of other companies that may be affected follow a similar pattern, though some have recovered slightly. First, let's talk about the medtech space. If GLP-1 treatments are very successful at scale, there could in theory be less demand for the products and services provided by several medical technology companies. Examples include the one we just covered, Dexcom. Dexcom's glucose monitoring systems are widely used by patients with diabetes. GLP-1 treatment could lower the incidence of type 2 diabetes or make it possible to manage diabetes without monitoring systems. Baxter International and DaVita provide dialysis equipment and services. GLP-1 drugs are currently being tested as a treatment for chronic kidney disease. Furthermore, using them to treat obesity and diabetes could reduce the incidence of kidney disease. Next up, ResMed sells equipment to treat sleep apnea. Lower rates of obesity could reduce the incidence of sleep apnea. And lastly, Intuitive Surgical sells equipment used for metabolic surgery. The demand for this surgery has reportedly already fallen due to GLP-1 drugs. Analysts and doctors believe that it's more likely that GLP-1 drugs will be used alongside other forms of treatment. Nevertheless, widespread use of GLP-1s is likely to result in lower demand for the types of equipment these companies use. Now, the next industry to talk about is food and beverage companies. If GLP-1 use becomes very widespread, there could be very real implications for food and beverage producers, retailers, and restaurants. JP Morgan research found that GLP-1 users purchased around 8% less food to consume at home. In particular, these consumers bought less high-carb foods like snacks and soft drinks. The chart below from Capital Group shows a meaningful drop in consumption of high-carb foods by GLP-1 patients. This could have a very real impact on companies like Coca-Cola, Kraft Heinz, McDonald's, and even Walmart if a large percentage of their customers use GLP-1 drugs. The silver lining is that these companies could adapt by selling more products high in protein rather than high in carbohydrates. In fact, Nestlé is already doing so with a new range of frozen ready meals designed for users of GLP-1 medication. Both food and beverage companies and medtech companies could be negatively affected if enough people use and find success with GLP-1 drugs. But, as mentioned last week, there are some hurdles to overcome before hundreds of millions of people use them on an ongoing basis. In particular, they need to be affordable and the side effects need to be manageable. Other industries that are likely to be impacted in various ways, both positive and negative, are health and life insurers. Weight management with GLP-1 drugs could reduce the incidence of diabetes, cardiovascular disease, and other conditions that end up costing health insurers more in the long run. But the numbers need to make sense. At the moment, health insurers are cutting back on coverage due to the high costs and number of patients stopping treatment early. So, with all that being said, what's the insight? Do you know how much you're paying for optionality? With all the hype around GLP-1 drugs, the valuation of some of the companies developing competing drugs are rising fast. Case in point is Amgen's PE ratio below, which has jumped from 19 times earnings to 56 times earnings. That increase isn't all related to the GLP-1 drug it's testing, but the optimism about these drugs has certainly played a part. A company has optionality when future innovations, products, or new market opportunities could result in significant gains relative to the cost and risk. Most companies have some level of optionality, but in some, it plays a much larger part in the valuation. Perhaps the best example right now is Tesla and its plan for robotaxis. If you estimate the fair value of Tesla as an EV maker alone, it will probably appear massively overvalued. But if you assume the robotaxi's business will be successful, the valuation may seem far more reasonable. The difference between those two values is the price you are paying for a business that does not yet exist, and you can't be 100% certain if or when it will. Ideally, you want to pay a fair price for the existing business and then get the optionality for free. But to invest in disruptive innovations and trends, you may have to pay a premium for that optionality. When you buy shares in physical pharmaceutical companies like Amgen and Roche, you are investing in a portfolio of existing drugs which generate fairly predictable cash flows, and you are also investing in a pipeline of drugs at various stages of development and testing. Of the treatments being developed, some will make it through clinical trials while others won't. Most treatments don't make it to clinical trials, while about 10% of the ones that do are ultimately approved. If you're investing in a company with optionality, it's worth knowing the premium you are paying for that optionality. You can do that by estimating the fair value based on the cash flows you are fairly certain of and subtracting that from the current share price. The difference between those values is the premium you are paying for potential cash flows. Whether the premium is reasonable or not depends on two things. Firstly, what is the probability of success or failure? The potential return needs to compensate you for the risk of failure. And secondly, when are the cash flows likely to materialize? The further into the future those cash flows occur, the lower they are worth today. The bottom line here is that the premium you pay for optionality needs to be discounted to account for the probability and timing of success. During periods of optimism, investors often overpay for optionality, as inflated valuations will result in larger optionality premiums. On the other hand, in periods of pessimism, savvy investors can sometimes get the optionality for free. So sometimes acquiring a great business with optionality to the upside is just a matter of patience. Now let's wrap up with the key events during next week. On Monday, China's Caixin Manufacturing PM for the month of August will be published. Economists expect to see a slight decline from 49.8 to 49.6. On Tuesday, the US's ISM Manufacturing PMI is forecast to rise from 46.8 to 47.5. On Wednesday, Australia's GDP growth rate is forecast to show the economy growing at 0.3% during the second quarter, compared to 0.1% during the first quarter. Year-on-year growth is expected to be flat at 1.1%. Canada's trade data will be published. The trade surplus is forecast to widen to $1.6 billion. The Bank of Canada will announce its interest rate decision and is expected to keep rates at 4.5%. The US JOLTS job report is due. Job openings are forecast to fall marginally to 8.08 million. On Thursday, Australia's trade balance will be released. Also, the US's initial jobless claims are forecast to rise from 231,000 to 247,000. The US's ISM Services PMI is forecast to fall marginally from 51.4 to 51.2. And on Friday, Canada's unemployment rate is expected to remain at 6.4%. US non-farm payrolls are expected to fall from 114,000 to 100,000. The unemployment rate is forecast to remain at 4.3%. Earnings season is winding down, but there are still a few popular companies due to report, including Zscaler, Broadcom, GitLab, DocuSign, UiPath, Asana, Samsara, Dollar Tree, Kroger, and Neo. That's all for this week's Market Insights. Thank you so much for listening, and until next week, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no position in any of the companies mentioned. This article is general in nature. We provide commentary based on historical data and analyst forecasts only using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock and does not take into account your objectives or your financial situation. We aim to bring you long-term focused analysis driven by fundamental data. Note that our analysis may not factor in the latest price-sensitive company announcements or qualitative material.